Hey, it's Jim, and this is level one of the CFA program, the topic on equity investments, and the learning module on company analysis, past and present. There's a term the Institute uses at the beginning of this learning module. It's called quantitative expression, which is a really cool way of the Institute explaining to us that it's going to require us to perform both qualitative and quantitative analysis when performing not just company analysis inside of this learning module, but industry analysis, macroeconomic analysis, security analysis, all these different analyses that the Institute think, and of course they are, super important. Now, at the back end of this slide deck, we're going to go ahead and have a conversation about some important ratios that you should remember from our financial statement analysis discussion. So the dabbling of quantitative analysis here in this slide deck is really pretty minor. We'll spend the first part of the slide deck taking a look at a company, looking at its financial statements. And of course, we have to have some quantitative background to be able to do this, right? I mean, you need to be able to add assets equals liabilities plus equity. But most of it is in terms of what kind of work are we going to do, and then how are we going to present it to the investing public. So just a handful of learning outcome statements here: describe, determine, and evaluate. But I want you to kind of picture the financial statements that we covered in those previous learning modules. So think about the income statement, right? Revenues and expenses, and then hopefully down at the bottom right, you have a net income, and that net income then gets switched back over to the bottom right-hand side of the balance sheet. So business model, revenue, profitability, capital structure, this really is a focus on those two financial statements. But those form just the basis. We're going to add a whole bunch of other material to complete, here, let me just go back here quickly, to complete our analysis of a specific company. All right, let's go ahead and start with elements. A thorough company research report. What does that mean? Thorough means that you have a beginning and you have an end, and then there's a whole bunch of stuff in the middle. And so what are we going to do? The beginning is, of course, the beginning, identifying the company, identifying the industry, and then coming up with a model. We have a really good slide here in just a few moments about identifying a business model. So I always tell my students that, these answer really, really important questions, like what product or service is provided? Who are our customers? How do we get that product or service to the customer? What kind of pricing power do we have? And then finally, supply chain stuff. So those are the 5 elements. And I'm going to ask you to take a picture of the slide that we have in just a few minutes. But what we want to focus on here initially is the simple fact that we're going to use specialized models. And what that means is that we're going to go from Harry Markowitz' Efficient Frontier. We're going to do William Sharp and Capital Asset Pricing Model. We're going to do Black-Scholes-Merton and the Option Pricing Model. We're going to do a bunch of other quantitative models. Now, we don't address those in this particular learning module, but they come later on in the program here, at least at level 1. And then we'll do lots and lots of that stuff in level 2. So I always try to tell you guys, don't lose sight of the big picture, right? This is just level 1, which leads us to level 2 and level 3, of course, so that we can use very proudly that designation. So look at that second bullet point there. These models are reflections of analysts' viewpoints and not a mathematical problem. So we're not going to say 1 + 1 = 2. We're not going to say assets equals liabilities plus equity, even though those are true, right? Those are true mathematical results. But what we're going to do is we're going to use those mathematical models, couple them with our qualitative models, and we're going to form, what was that term I just used? A quantitative expression. And this is what I tell my students, and you guys will hear this a lot in level 2 in my recordings, is that financial research is a combination of math and science and artistry, right? There's an artistic element to all of this where we do the math, we use the models, and we say something like, oh, you know what, 1 and 1 is equal to 2, but there's a range there. Maybe 1 and 1 equals between 1.1 and 3.5, and we got to figure out what that range is. And that brings us to the artistry element of financial analysis. All right, so let's go ahead and start at company and industry analysis. What we're going to see here in a few minutes, and I remind candidates of this all the time, is that the Institute is very big on top-down and bottom-up approaches. And so when we start with the company, that's going to be a bottom-up approach. When we start with the macroeconomy, that's going to be a top-down approach. So company analysis, what does this mean? And look at that embedded, that bullet point involves studying past and present financial statements. All right, so now, let me just go back here quickly. Now you know why the Institute calls it past and present, this learning module. Now, you heard me say this back in our financial statement analysis conversations, that it's important to put together and evaluate those financial statements, mostly in terms of ratios. But we've got to do two things with those ratios. We need to look at history, right? So trend analysis, maybe technical analysis there. And then we need to compare it against our peers, our peer firms. So we have a trend inside of our company, and then we have a trend that is an industrial trend, right? So look at the last part of that. To form a view of its future financial results. You know, what's the best way to look at the future? Maybe I shouldn't say it that way. What's the easiest way? What's the first step in looking at the future? And the answer is, well, what has happened in the past? You know, there's that famous saying that said, those who don't study history are doomed to repeat it. But here in financial analysis, we're saying something like, those who don't study history have no concept of what's going to happen in the future, right? We know this from our conversations on the 2008 financial crisis. We know all of the problems that occurred back then, and that's why the Institute emphasizes things like mortgage-backed securities. We know about all of those problems that occurred, you know, in 2008. We want to make certain that we are on top of those mistakes and that we can identify those mistakes before they occur again as good financial analysts. All right, so we have a couple of steps here. Take a look at history. So there's the business model. I'll talk about that again in just a few minutes. We'll talk about revenue and revenue drivers. So those of you who are interested in economics and who are interested in marketing will really love this this section on revenue and revenue drivers, right? What are those? Those are P times Q, right? Price times quantity. So what drives price? And what drives quantity? Well, you need to know the business model to be able to do the economics and the marketing of that. Then work your way down the income statement until you get to something that you might think of as EBIT or operating profit or operating profitability or income from operations. You know, different firms call these things different terms on their income statements. So think about the kind of the middle of the income statement. You know, you've heard me say this before, at least I hope you've heard me say this before. You know, what's the goal of the business? Maximize shareholder wealth. How do firms do that? Well, there's a bunch of different ways. One way is to make something for pennies and sell it for dollars. So that's the operating profitability. And then we need to ask ourselves the question, what happens in the upper middle portion of the balance sheet? We're going to call that working capital, right? The difference between current assets and current liabilities. And what those two things do, right, analyzing operating profitability and working capital, they allow us to take the next step to look at positive net present value projects. So there we are, analyzing capital investments, and then capital structure, the difference between debt and equity over on the right-hand side of the balance sheet. So that company analysis, past and present, think income statement and balance sheet, just like I spoke about during my introduction. Then we'll go ahead and ask ourselves the question, okay, here we are, and we're looking at this company, and we're looking at the idea that this company doesn't exist in a vacuum. So we want to look at our competitors and the entire industry. And so we're going to look at things like industry growth. We're going to look at things like industry profitability. And of course, we'll use the financial ratios that I just talked about just a few moments ago. And then we'll look at external influences and competitive advantages. So think of that purple column in there as looking outside of our little own box. And then what we're going to do is we're going to take step 1 and step 2, and we're going to form some type of a prediction. We're going to make a forecast. And there are all sorts of models that we can use about forecasting. This is why the Institute takes us through all of the economics learning modules, all the quantitative learning modules, all of the financial statement analysis learning modules, so that we can form some kind of a reasonable forecast. I mean, it's one thing for us to look at a company, let's say like McDonald's. And let's suppose McDonald's had 100 in sales last year. We could say, oh, you know what? Their historical growth rate has been 2%. So we think we're going to estimate revenues at 102. I mean, that's a pretty basic idea about forecasting. But we want to throw lots and lots of extra variables into that model so that when we come up with that forecast of revenues, maybe it's 102, maybe it's only 101, maybe it's 110, whatever that number is, that we're using everything that we learned back in column 1 and in column 2. And then I love this last bullet point down there on the bottom right. The Institute is very big, and I don't really remember this as being a point of emphasis when I went through the program. Now, this was, over 2 decades ago. Identifying and then evaluating key risks and uncertainties. I think the Institute has evolved over the years, just like we all have, after the 2008 financial crisis, when it was discovered that firms probably need a chief risk officer. And identifying those key risks and what they mean in terms of an uncertain future and the ability to make those predictions. We're going to talk about this concept of, let's call it just a simple value at risk. I think we get to that in level 2. I mean, that's a huge component of trying to figure out key risks and how history can be our friend rather than our enemy in making these forecasts. I don't teach our security valuation class at my institution, but if I did, what I would have my students do is pick a company and go ahead and make an initial research report and then a follow-up report. And the Institute is really big on this. So the next couple of slides here are going to identify this initial coverage and then the subsequent coverage. And so let me go back here quickly. We're going to do all of this stuff and put it in an initial company research project. So what can you imagine goes into an initial research report? Well, everything that you can think of, right? Here's where I was going to ask you to go ahead and take a picture. So get your phone out, take a picture of this, and it continues here on the next page, and then it continues here. So I'm going to ask you to take 4 pictures, I think. I think it has to be 4 pictures here. All right, so the structure of the initial company research report. All right, so we've got this front matter. What does this mean? Of course, we're going to say something like, hey, what's the company's name? What do we know about this company? What kind of disclaimers? What kind of disclosures? I say this regularly. The Institute is really big on disclosing. Like if I'm the analyst here and I'm covering Johnson & Johnson and my wife is the chief executive officer for Johnson & Johnson, I ought to put that in there, right? Disclosures, any kind of disclaimers. And I think the Institute has really been influential in the news journalistic reporting industry, because I regularly read in the Wall Street Journal and watching business news shows where an analyst will come on and say, oh, by the way, my wife is the CEO of this company. And I'm guessing the Institute has had some positive influence there. At least I'm hoping that that's the case. That front matter is essentially kind of like an executive summary, not a complete executive summary, but it has some elements to it. And then, of course, that's going to be followed by the analyst recommendation, right? Supporting reasons. I think this is a buy. I think this is a sell. It's not sufficient to say, I think you should sell or consider shorting this company because they stink. That's not sufficient, right? Supporting reasons. And so those supporting reasons, they're going to come from at least column number 1 back here that we just talked about. company description, there we'll get into the business model, the strategy, key charts and figures. I always tell my students about knowing the board of directors. I give this question in my classes all the time. In fact, we go to the Johnson & Johnson webpage and we take a look at the board of directors. Currently here in the 2020s, Johnson & Johnson has about 12 board members. And, these are really, really smart men and women. And I ask my students the question, are these men and women, do you think that they have the skill, the background, the technique, the opportunity to be good stewards of the bondholders and the shareholders' capital? So that's probably a part of that, key figures, board of directors, and CEO. Then we need to go outside of the company, take a look at the industry overview. Notice there's that pestle in there. I think we've talked about that in a previous learning module, where you take a look at things like, all right, this is kind of a summary of what's going on politically, what's going on socially, what's going on environmentally, technologically, all those different kinds of things, how those external events, how they impact the industry and how they impact our particular firm that we are covering. I say to my students, I use the example of Milton Hershey, and I do this in my recordings as well, is that, suppose that the Surgeon General woke up this morning of the United States and said, you know what, chocolate is bad for you. I remember when I was in high school, I had some acne problems, and my mother used to say, you need to stop eating chocolate. So maybe the Surgeon General will say, chocolate is bad for your complexion, don't eat it anymore. I mean, think about what kind of an impact that would have on Milton Hershey's balance sheet, income statement, cash flow statement, reputation, brand names, all that kind of stuff. Imagine the response that Milton Hershey would have. I'm certain they would have a very clear, complexed teenager come on and say, I eat 20 chocolate bars every day and look at how beautiful my face is. All right, so you get my point here, is that you got to watch what's going on environmentally and externally, and then you got to watch how the firm responds to all of these things that are going on outside of it. All right, here we go. Detailed evaluation of all the models, right? Historical and forecasted financial statements. And then we'll come up with evaluation. And this is where we can use something like as simple as the Myron-Gordon growth model. Take the present value of the dividends. Probably won't use that, but that's a really good starting point to maybe substitute free cash flows in the numerator and then use the capital asset pricing model to estimate that required return on equity, and then use some kind of industry growth estimate for the growth rate there. Wow, boy, see how I just turned the simple Myron-Gordon growth model into a super complex valuation model. And then the Institute is very big on social, government, and governance and environmental factors. And so these are super impactful on the financial statements. Those of you who pay attention to politics and the Securities and Exchange Commission and even the Fed, there's talk about having companies have some kind of a unique and specific representation on its financial statements to consider ESG. And then, of course, as much as I love all the stuff here, my favorite is this bottom one, evaluation of potential risks. And I teach my students that whenever they put together a paper, not just for my class, but for all other business classes, they ought to base it in a SWOT analysis: strengths, weaknesses, opportunities, and threats. And if you do that, you don't have to call it a SWOT analysis, but that's what I always think of here when I talk about risk. So evaluation of potential risks. And I'm one of those individuals that always say something like, all right, here's our decision. What's the worst thing that can happen? And I'm guessing that lots and lots of chief risk officers and boards of directors were asking themselves the question back in 2018, what happens if something gets into the air and everybody gets sick and everybody in the world gets sick. How unprepared were we for COVID? Maybe some firms were super prepared for it, but how prepared were governments? And so we could have that argument for lots and lots of days, but I love this evaluation of potential risks. And so this is super important, at least from my perspective. And I think the Institute is on top of that as well. Now, we made a note down here at the bottom. This is exactly reflective of one of those inside of the learning module questions. What we need to make certain is to know our audience, right? If we're solely internally distributing that and our audience is super familiar with this particular company or the issuer, then we probably don't need to have a massive kind of a presentation. But if our audience is ignorant, and this is all the way I tell my students when they make a presentation to me or the rest of the class, is just pretend like we're idiots, right? We don't know anything about this company. We don't know anything about current ratio. We don't know anything about any of that stuff. That way, as a professor, I get to evaluate them at the base level, and then, I could kind of build up and see where they're going. So that same kind of a principle holds true here. All right, so let's quickly go through the subsequent research report. Front matter, this is pretty much same thing that we did before. But the recommendation and the analysis of new information, the valuation and the risk, notice that in every one of those far right columns, we could have just put the word, hey, update what you did before. So the recommendation, the updated recommendation, and then the reasons that we updated the recommendation, and then skip down to the next section. Well, it's probably due to the fact that the company has released, maybe the previous quarter or maybe the previous year, whatever it is. So we're going to interpret that new data and say something like, hey, you know what? The old data was like this, and it had this indication, and now the new data is like this, and it has a different indication. And we used a different model. We updated the model, we found a new variable, etc., whatever it is down in valuation, and then updated risk factors. Imagine the Johnson & Johnson, here, let me go back here, the Johnson & Johnson initial report in, let's say, 2018, right? And then imagine the subsequent report in 2019 after COVID and President Trump said we're going to have these vaccines, and there's Johnson & Johnson. I mean, that's a huge difference between the initial and the subsequent. I mean, I'm not suggesting that you should wait a couple years in between these kind of things, but boy, oh boy. All right, so we need to take a picture of this thing here and this thing here, right? So go ahead and get your phones out again. Business model elements. What this is going to do is help us to evaluate and summarize those key drivers. So I rattled these off at the beginning pretty quickly here. So business model elements. What are the goods and services offered? Who are the customers and maybe customer groups? How do we get, what did I say earlier? How do we reach that particular audience? So the Institute calls this sales channels. And then skip down on the bottom there, what is the supply chain, resources, suppliers, collaborative entities, and then skip one up there. There's the pricing model. So make sure that you remember all the stuff that you learned back in the macro and microeconomics about what is it a monopoly, is it perfect competition, all that kind of stuff with the pricing model. And then embedded in that is, all right, we make the sale. And how do we collect that? How do we collect that cash? Of course, that's an important concept of working capital management, which we'll do here in just a few minutes. So how do we determine what that business model is? Well, we just ask the company, right? If we're a well-known analyst, we can just pick up the phone and call the CEO of Johnson & Johnson and say, hey, tell me about your business model. But if we don't have that kind of access, well, we can get it in publicly available information. We can do this from third-party sources, industry reports, economic indicators. I tell you guys this all the time. Make sure you read the Wall Street Journal every day. They're news outlets. Social media, I say this regularly. I don't know anything about Twitter or X or whatever it's being called. I don't want to know anything about this. But if I'm a financial analyst, I'm going to know all about Instagram and X and anything else that's out there. And then proprietary primary research. So, of course, we can gather this ourselves, surveys, product comparisons, interviews. But what we're likely to do is just to pay somebody else to do it. You guys know I like to give James Bond references. How about that great James Bond movie, Goldfinger? Art Goldfinger, what do we know from the movie? He was just a dude who did something with gold, right? And he was a bad guy. And James Bond took him down at the end of the movie. But suppose we're going to analyze and evaluate a gold mining company. Well, you can go like this and look at any of you guys married, I can look at my wedding band. My wife and I, we each paid $100 for our gold band back in 1990. Wow. We can do that and we can say gold, right? We can watch Goldfinger. There are other movies out there, but man, what do we know about gold mining? I'm not very smart. I just figure there's a bunch of people get the shovels out and they dig and they say, oh, there's a bunch of gold. Let me go sell it. But man, oh man, what do you guys know about the difference between doré and concentrate? Oh my gosh, there's important concepts in the mining of gold. So it's probably better for us just to say something like, hey, you know what? That person over there, I think they know more about it. How about if I just pay them to do it? All right, how about moving on to revenue and revenue drivers? This is what I was saying earlier about price times quantity, right? So what are we going to do? We've got the P, which is the pricing. We have the Q, which is all the quantity. So all of the marketing, all of the economics, all of the business strategy stuff that goes in there. What this means is that can be summarized by what we call a revenue driver. Are we driving revenue by lowering our price to a point where we're wiping out all the competition? Or are we developing a brand name product line so much so that we can restrict the quantity and that we can bump up the price? Or are we flooding the market with our quantity? Or, right? There's a lot of different ways to reach P times Q to total drivers. All right, so how can we do this? I said this earlier. The Institute, they love to ask bottom-up questions and top-down questions. So what we're going to do, bottom-up, of course, means that we start at the ground level. We'll build this upwards. We're going to start with all of our internal data that we have, company's operation and product performance. Of course, we'll look at the history of this as well. What kind of factors are important? Sales volume, price. And then we're going to divide those P times Qs by product line, by segment, by geography, by cash flows, by sales force, by. I mean, there could be 100. That sounds like a lot, but there can be many, many additional drivers, right? So we start there and then we work our way up and say something like, oh yeah, total revenue would be, what I say for McDonald's earlier, 102. Or what we can do, and this is what I have my students do when they work on their policy statement for a fictional client, I tell them to go ahead and look at the broader macroeconomic market. Start with a macroeconomic analysis. Well, the top-down approach here, it might mean that we need to look at the entire economy and how that relates to things like, well, what are some important variables? Employment, GDP, inflation, all that kind of good stuff. And then how does that worm its way down to an estimate of our revenues? So in my MBA class, I always have my students, we pick a company. It's a large company that everybody knows. A couple semesters ago, we picked Malibu Boats. And so what I said to them was, hey, Malibu Boats is going to introduce a golf cart product line. So I said to them, your first step is to go out and find out how many golf carts are sold in the United States, right? The broad market. I don't remember what that number was, but whatever it was, that's how many golf carts. So then Malibu Boats, who knows nothing about this new product line, that's part of the assignment. Malibu Boats has to decide, all right, here's the entire market. How much of that market share can it capture? Right. So do you see the idea of you going from the top down, the entire market, and then maybe the industry, and then maybe a sub-industry, and then, whatever. And so I asked my students, I said, You need to decide, are you going to make a golf cart that you're going to sell to country clubs, or are you going to make a golf cart to sell to just a regular municipal golf course? Well, that really depends on, what is our business model and all that kind of stuff that we're talking about. And then, of course, related to both bottom-up approach and top-down approach is this pricing power. So I'll say this again, what's the goal of the business? Maximize shareholder wealth. Lots of ways to do this. One way is to develop a brand name product line. So if we have a brand name product line, we have some pricing power. If we don't have a brand name product line, we don't. We're kind of a price taker. So what are these influences there? Market structure, right? We learned all about that in economics. The competitive position. So there's our brand loyalty. There's branding. There's product uniqueness. What happens if we have this highly competitive market? Well, that pretty much means, you think about it, there's that flat curve that we learned about back in our microeconomics days that, the price is whatever the price is. And we have to figure out how to manage the left-hand side of our income statement so that we can make some money as a price taker. Yeah, price wars. Prices are driven down to marginal cost. That's what I was talking about just a second ago. Little product differentiation. I struggle with this concept because I'm not a marketing person, but it seems to me like everybody out there is selling a differentiated product. I'm the only one in my family that doesn't have an iPhone, and I don't want to have an iPhone, and I'll never have an iPhone for just a variety of reasons. But my phone pretty much does the same thing that the iPhone does, although my family members, they always, they're very critical of me. But it's a phone, right? But they say, oh yeah, but I can connect it to my iPad, or I can connect it to this, to my stereo in my car. And I'm like, well, I don't care about that stuff, but I can do it the same way, right? So I don't really know what product homogeneity means, just from my perspective as a consumer, but that's probably an important part here from maybe an academic perspective here. All right, low barriers to entry, some more branding loyalty. Yeah, there we go. Now, what happens if we have less competitive markets? Well, then we have some kind of pricing power. Here's where, and this is what I was saying earlier, I think there's tremendous product differentiation, right? At least there's that attempt to differentiate the product. Maybe I'm just a kind of an old soul or an old dude in my 60s who is not influenced by all this stuff out there. Maybe that's because I don't do any social media. Maybe if I swiped away on social media every day, that I would say, oh my gosh, I need to buy an iPhone. All right, more barriers to entry, customer loyalty. Consumers are less price sensitive. Now, we learned this in the 2020s with, what do we have, 9% inflation here in the United States. Excuse me. Those of you who live in other countries, you might be used to 20% inflation or 30% inflation. But what we found here is that, boy, these brand loyalty was really stressed during COVID. Companies use value and cost-based pricing. Yeah, that makes perfect sense. Healthy profit margins. Yeah. Now, how are we going to make the segue from our qualitative discussions to a little bit of quantitative methods here? We're going to do it in this learning module with operating profitability and working capital. So look at that first arrow point. 2 key measures. All right, operating profitability, this is just, hey, make something for pennies, sell it for dollars. Working capital is, hey, can we meet our short-term obligations with the cash flows generated by our product lines? So let's go ahead and look at the left-hand side of the balance sheet, these operating costs. So we just did revenues and revenues drivers on the top right-hand of the income statement. Now we're doing the middle left hand side of the income statement. All right, so what do we have here? 3 groups that we can categorize these operating costs. So responses to production levels, right? So if we make more of something, then it probably costs us a little bit less per unit. But what we need to do is divide these into variable costs and fixed costs, which we did back in our financial statement analysis stuff. And then the nature, the type of the cost, where are we inside of this flow chart? How do we throw employee compensation in there? Does it look like a raw material? Is it a work in process? Have we shipped it out? All different sorts of other things. Look at that, office supplies. Can't imagine the Institute giving you a question in which you have to worry about office supplies. And then we can do this, we can categorize this by function, the primary reason. And so this is something that I think is super interesting. Just my accounting background here. I love looking at the cost of goods sold up there. This is exactly the make something for pennies and sell it for dollars. And then we need to worry about other stuff, right? What are those general costs? What's the overhead? What are the administrative costs? How much do we pay our sales force? What are we doing in marketing, research, and development? Yeah, let me go ahead and just remind you, we had really good conversations back in our financial statement analysis conversations about what do we do with research and development? Do we expense it? Do we amortize it? All those fun kinds of conversations. Fixed and variable costs, you probably don't need me to remind you of this, right? Fixed costs, they remain unchanged. You turn the lights on, they're on all the time. You have to pay for the lights whether you're manufacturing something or not. But when you turn the conveyor belt on, that's a variable cost, right? So there's a good equation down at the bottom for operating profit. We do this with our Q's and P's, right? So we take Q and then we multiply that by price minus the variable costs. Excuse me. And then we subtract out our fixed costs. Boy, here's a super quick example. Ready? Fixed cost $10,000, variable cost $5,000. Each toy is sold at $20. There's the operating profit of $5,000. So the LOS doesn't actually say go ahead and compute the operating profit. However, it's super simple. I would be prepared to do this, of course, based on everything that we've done in other learning modules. But I would go ahead, evaluate, interpret, analyze, whatever those other action words are. I think the better question is for the Institute to say something like, hey, here's ABC toys, here are these input variables, and then the question would be, of course, the operating profit turns out to be $5,000, right? Of course. And then comma, and then ask you to interpret or evaluate it. And maybe it'll give you some information. Maybe the previous year it was $4,000. Maybe the previous year it was $6,000. Maybe the competition is making $10,000, so the evaluate is more important than the actual calculation, but of course you should be aware to calculate it. Now, I love having this conversation about leverage. Leverage, of course, means having an advantage. And what we do is we have several advantages on the income statement. We can use fixed costs in operation to our advantage. We can use fixed leverage costs of issuing a bond to our advantage. So anytime that we use this concept or term of leverage, it means what we're trying to do is squeeze something else out of what we're already doing. So we'll go ahead and focus, at least in this learning module, on operating leverage, the amount of fixed costs in the operating cost structure. So we need to know contribution margin. That's just the price minus the variable cost. So let's do degree of operating leverage. And so this is super cool here, right? So we're going to have percentage change in sales in the denominator, percentage change in operating profit, which we just calculated in the numerator. And so what we're going to do is ask ourselves the question, what happens if we increase fixed costs? What happens if we decrease this fixed cost? What does that mean to our sales, right? What are we trying to do? Key drivers of revenues. Well, maybe we want to use this fixed cost structure to increase our sales. Let's do just a really quick example here. So we've got 2 years worth of revenues and all the way down on the income statement to net income. So the question then becomes, let's go ahead and compute. Here, let me show you what the question is. We want to find out what that degree of operating leverage is. So we need, let me go back here. We need percentage change in operating profit. We need percentage change in sales. So I taught you this back in beginning of time value of money. This is just an F over P minus 1. And so all we're going to do is, say, 15 over 14 minus 1, and then 32 divided by 2920 minus 1, although this is the way the Institute does it in the learning module. I always tell my students and the candidates, F over P minus 1 is the simplest way to do this. You don't have to worry about anything else. So you get, what is that, about 7% and about 9.5%. And so all we're going to do then is put 1 in the numerator, 1 in the denominator. So 1.34 is our degree of operating leverage, which means that if we increase our sales by 1%, right, that's in the denominator, then our operating profit will increase by 1.34%. Now, remember I said something about our recollection of financial statement analysis stuff and the international rules and the GAAP rules. There we go. You can present these operating costs in two main ways: natural cost or functional cost classification, rather than classifying them into variable and fixed costs. So whatever we're doing in this section here with these LOSs, make sure you remember what we talked about back with the international and the US people. All right, so let's have a little bit of a further conversation on natural cost based on their nature. So salaries, rent, utilities, and raw materials. What does that mean? You know, do you remember that great scary movie, Silence of the Lambs? Hannibal Lecter says to Clarice, look at what is its nature. You know, they're trying to catch a serial killer. Well, I don't mean to scare you. And if you haven't ever seen that movie, it's a great movie. But man, oh man, you'll sleep with a flashlight near your bed for some time after you watch that movie. But what of its nature? You know, salaries, we know what that is, right? As opposed to a functional cost classification means the functions that they serve. And this is exactly what I was saying about making something for pennies and then sell it for dollars, right? So cost of goods sold, administrative, yes. So that income statement can have a standardized structure, right? And so you can easily compare that functional cost across companies in the same industry. All right, let's move on to more quantitative stuff. We should know this from our financial statement analysis, right? Operating profitability, let's just take gross profit, revenues minus cost of sales. What we can do is put that in a ratio, call it gross margin. What we can do is we can compute some kind of operating profitability. Let's call it earnings before interest and taxes and depreciation and amortization, and then we can throw 1 in the numerator and 1 in the denominator, call it EBIT DA margin. And so, you know, here's the gross margin. What do we want that number to be? Of course, we want that to be high. EBITDA margin, what do we want that to be? We want that number to be high as well. We can go ahead and cut it off at just EBIT. We can do the margin there as well. What those ratios do in those previous slides, what they help us to identify are these cost drivers, right? And we're going to find these probably in the notes to financial statements, right? The major driver of operating costs is the output, right? Of course, that makes sense. What do we need to worry about? Growth in assets. We need to worry about what we're out there manufacturing and buying inside of that process. What is our human capital? A lot of times we'll go ahead and express operating costs as a percent of revenue. And then if we're doing this in comparison to the industry, we need to worry about economies of scale and economies of scope. Let's go ahead and look at these in just a little bit more detail. Profitability of the industry. This is what I was saying earlier. When we perform an industry analysis, we need to know about the competitive structure and the competitive dynamics. What is our market share? What's the potential change in market share? The Institute calls that relative positioning of the firms in the industry. Economies of scale and scope, we know this from our economics conversations, right? Refer to a decline in costs per unit as the output grows. Economies of scope simply means that we're we're probably not a company that does just one product line. We have maybe 5 product lines. So the costs then are related inside of those product lines. And part of economies of scope, by the way, is that, suppose we have a silo here, and inside of this silo, we're a donut making machine, and we make donuts, and we make, several different kinds of donuts, but we also make brownies. And we also make birthday cakes, so we probably have an expert donut, an expert brownie, and an expert cake person. And so we have probably a chief risk officer or maybe a chief operating officer, overseeing this silo. And that chief risk officer probably knows a lot about this. And so that economies of scope reflects, kind of the human element across business product lines or projects. Let's go ahead and move on to the balance sheet here. Working capital, that's just current assets minus current liabilities. And I think what the great question is not for the Institute to say, hey, look at the balance sheet. Here are current assets, they're 100. Here are current assets, they're 50. So working capital is 50. I think the more interesting question is to evaluate, what's that LOS? Evaluate the changes in working capital over time. Right. So this is a measure of a company's short-term financial health. Remember, current assets and current liabilities. So how do we do this? Well, we have this cash conversion cycle that's shown down at the bottom. What this means is that, think about it. Let's go back to the donut factory. What do? We sell a bunch of donuts, and let's suppose our revenues are 100. But, only 10 of those people pay us cash. 90 of those people, we accept an accounts receivable from them. So how long is it going to take them to pay? Maybe some of those people will pay next week. Maybe some of those people will pay next month. Maybe some of those people won't ever pay, right? So we need to worry about that length. We also need to worry about, if those donuts sit in our shelves for a week, we have to throw them out, right? Of course, that's very different than if we're an auto firm. We don't throw out a Honda Civic just because we haven't sold it in a month or two. This is a good slide on this cash conversion cycle. And this is pretty much what I was talking about here. But what I did is I focused on the accounts receivable. I didn't focus on the accounts payable here. So cash conversion. How can we convert investments in inventory and other short-term assets into cash? So there we go. Days payable outstanding, days of inventory on hand, days of sales outstanding down there. So you can do this cash conversion cycle. I don't imagine that the Institute would say, hey, how many days is in this cash conversion cycle? Once again, I think it's important to look at the history of this and to try to minimize this, right? What do we want to do? We would prefer to sell $100 in donuts today and receive $100 in cash today. But the business world just doesn't work like that just because, well, what are we going to do? We're going to just drive around and collect cash from 1,000 different places that buy our donuts. It's just not convenient. And plus we have Venmo, whatever Venmo is. I don't have Venmo, but apparently my wife and children do. All right, so here's just a summary of what those terms are. So as you can imagine, we're going to go ahead and throw these into ratios. So let's put net working capital over sales. Yeah, what do we want this ratio not to be, right? If it's a high ratio, that's probably some type of a suggestion that our working capital management is not being performed efficiently. There's really no general idea of what is a high or a low net working capital to sales ratio. But what my guess is that the Institute will say something like, hey, here's our ratio of the last 5 years. Here it is now. And I think the easiest way is to have the ratio be relatively constant historically, and then have it way above or way below in this current evaluative period. And then that's kind of the obvious answer. All right, how about sources of capital? Well, we know this from our learning module on the corporation, what's the best source of capital? And this is the cash flow from our current product lines. What else can we do? We can issue bonds. We know firms do this all the time. We can issue shares of stock. We know firms do this all the time. Now, let me go ahead and make a comment here. When a firm issues debt and it issues equity, its most likely and most efficient outcome is probably to invest in a positive long-term project. But some of the bond issue, some of the equity issue can be allocated to working capital needs. Oh, this is super important. Look at what we have there, investing in physical assets and intangible assets. Well, there are short-term components like maybe maintenance or something to machinery. So we want to throw that into working capital needs. My point here is that, of course, remember, issuing bonds, issuing shares of stock is for primarily raising long-term capital, but it has its short-term efficient outcome, and that's what the Institute is talking about here on this slide. And then, we want to sell off assets when we want to sell off assets. We don't want to have to sell off assets when we're in bankruptcy court. Here's a relatively recent example, Johnson & Johnson. We've been talking about them, right? They sold off their consumer product lines with, I'm not even sure what it was called. It was some kind of an equity carve out, some kind of an initial public offering. But there's another company out there that does it, even though Johnson & Johnson still owns. I don't even know how much Johnson & Johnson owns in that new company. But selling off assets, you can do that. All right, long-term returns on invested capital. This is exactly what I was talking about with investing in positive net present value projects. What does this mean? That it means it's going to generate cash flows next month, next decade, next century, so that if a company consistently shows a high return on this invested in capital, well, this is probably a good sign, right? Part of our evaluating a company's capital investments means evaluating the executive leadership team and evaluating the board of directors. But ultimately, this comes down to a quantitative measure that says something like, all right, the investors provided us with 100 and we turned that 100 into 1,000 over 5 years. Well, that sounds like high return on invested capital. However you want to measure that invested capital. Now, what did we do earlier? We did degree of operating leverage, which was a conversation on the fixed assets advantage in trying to generate extra sales. Well, we can move down the balance sheet and discuss this concept of financial leverage. So this financial leverage, let me go back here quickly. This is issuing long-term bonds. When you issue a long-term bond, you necessarily increase leverage. And so what we want to do is let's take Milton Hershey. Milton Hershey wants to issue a bond in the amount of 100, right? Invest in a new chocolate machine and have that new chocolate machine generate $1 million in sales, right? But what we're doing with degree of financial leverage, this is the exact same thing of degree of operating leverage. We're just farther down on the income statement. We want to ask the question, what happens when that degree of operating income changes? How does that impact the very bottom of the income statement? So if we have a high degree of financial leverage, what that means is that we have lots of debt in our capital structure, which means that if we have small changes in the middle of the income statement, we're going to have large changes at the bottom of the income statement. Now, let's move on to this concept of financial leverage and levered returns. So look over on the far right. We've got return on equity at the top. That has two components. It has the return on asset component, right? So this is what I was saying at the very beginning. What did I say? 1 + 1 = 2. And I said assets equals liabilities plus equity. So we're relying on that quantitative model. My gosh, we learned that in kindergarten, right? So that return on equity has the two components. The regular old return on assets, which is just net income over total assets, plus this concept of leverage. And that brings into this the idea of how much debt is in our capital structure. What about that financial leverage? What you can do is you can decompose return on assets into net profit margin, which shows up on the income statement, and the total asset turnover, which is a ratio of what's going on in the income statement versus what's going on in the balance sheet. You can further decompose that net profit margin into the interest burden, into the tax burden, and the margin. And so, this thing is pretty standard accounting framework. But what's the point of looking down here on this right-hand illustration? The point is that what do we want to do? We want to maximize shareholder wealth. How are some ways to do it, right? What have we said? Make something for pennies, find branded product lines, or, and I hesitate to say this, so don't tell your finance professors that you heard this from me. I'm not going to say this, but I'm going to go ahead and say it anyway. Maximize return on equity. Now, we don't want to do that in the short term. We want to maximize return on equity over the long term. So there's a huge difference in how I'm saying it, right? So what do? Well, we do all of these things here. We talk about leverage, we talk about profit margin, we talk about working capital, we talk about taxes, we talk about all that kind of stuff that has led us in this slide deck to this return on equity decomposition. Let's go ahead and end with a quick example of addressing this LOS, capital investments and capital structure. So let me go ahead and give you a little background about this simple example. Here we have a firm that does something, right? And then this firm is going to go ahead and issue a bond. And the question then becomes, how does that bond issue impact our capital investments? How does it impact our capital structure? And then ultimately, how does it impact the return on equity? All right, so you ready for this? So here's a company, initial investment, an equity investment of $100,000 generates a profit of $10,000. So there's a simple return on equity calculation, 10 over 100, right? 10%. So you get a sense of this company, its balance sheet, and its profitability. So you would think that if this firm doesn't do anything, that over the next year or two, whatever, that its return on equity is probably going to be somewhere around 10%. But let's suppose we issue a bond. So there we go. We borrow $100,000. Notice that's the same as the $100,000 initial equity, right? So we're paying interest rate of 5%. So we have total capital of $200,000. Of course, there we go. Assets equals liabilities plus equity. So using this debt, the income increases to $20,000. So think about it. We had $10,000 before. Now we have $20,000. But we have to pay the interest on the bond, right? So that means $20,000 minus the $5,000 of interest. That leaves us with $15,000. So what about this measure, right? Return on invested capital. Well, all we're going to do is take the 15 divided by the total, right? 200,000. So that's total assets, equity of 100, debt of 200. So our return on invested capital is 7.5%. But notice what happens to return on equity. We've increased the numerator without changing the denominator. So the return on equity is 15%. This is the beauty of financial leverage. What do I always tell my students? What have I said to you guys in previous recordings? That leverage magnifies returns. In this case, this was good news. Leverage magnified a positive return. We turned a 10% project into a 15% project, right? We squeezed an extra 5% out because we borrowed somebody else's money. Now, there's a consequence to that. What happens if the income goes down? So the Institute says something like introduces additional risk, and this is just the Institute's way of saying, hey, in this example, there's the beauty of leverage, but in a different example, when income falls, there's the ugliness of leverage. So those are the additional risks. Remember, financial leverage means an increase in financial risk. And that takes us through this super fun equity topic, past and present. So thanks for watching. I want you to go to the learning module right now. There are 7 questions there. I'm guessing you can do these in less than 7 minutes. So work on that. Have a great day and good luck studying.